Well, hello everyone, and welcome to September the 6th, 2024. I am Delbridge, Benchmark Realty, Murfreesboro, Tennessee, and this is your status chat. We got a lot of stuff to get to today, and I don't think it'll be too unpleasant, so let's get started. If you like this content, please go to CallDelToSell.com, find the tab that says on YouTube, click it, and it'll open up a page of QR codes. There you can use a smartphone to scan and get to the YouTube page, or you can just mouse over and click it on a PC. There you'll be able to subscribe to this little button over here and click the notification bell so that YouTube will notify you when each Friday's blog has been uploaded. Thank you. The JOLTS, because we've been waiting for the JOLTS to see what we might be doing with the Fed. Now, I personally can say I'm not sure that it matters a whole heck of a lot as far as that goes. In some ways, as crazy as that sounds, Chairman Powell has been saying since December of 2023, we're looking at maybe up to 3 cuts starting with Q3 of 2024. And then they kind of walked a little bit that back and they've come over. But I think at this stage of the game, if they don't cut 25 basis points, I think that's going to lead some people into a little bit of a panic, thinking that inflation is going to go out of control. And I think if they cut it 50 basis points, I think people are going to think that the economy is out of control. So for me, the safe bet is to go ahead, keep schedule, and do 25 basis points and not be too rambunctious about the labor market or inflation or anything like that unless we actually see real numbers. Now, we are continuing this pattern of having stuff, revised downwards. We lost a big bunch of jobs here just recently, but here we are. U.S. Bureau of Labor Statistics. If we go back, I've shown you this before, back in the bad days, the good old bad days of 2008, look how high unemployment was as far as numbers of employment person per job opening, the rate there we go. And yes, we are rising up in the last little bit, but it is not overly excited. It's just kind of creeping back up a little bit. To me, it doesn't look like it's a terrible, awful, most worst day in the world time. We're not going to look at this too much. We just want to look at the things we've got going here. The JOLTS is job openings, and also it has to do with turnover. So job openings on the last business day of July, the number of job openings was little changed at 7.7 million and was down by 1.1 million over the year. So this is telling me, it's reinforcing that we don't have to be in a great big hurry as far as job openings go. Yes, they're down, but they're not drastically down. We can take a look at where they're down. State and local government, excluding education, was down 101,000. And transportation, warehousing, and utilities down 88,000, 28,000. And professional and business services, we actually saw an increase in those openings. So private is going good. We're just kind of trimming off some of the government spending. In July, the number and rate of hires changed little, about 5.5. We're going to hear this pretty well much through this whole report. Separation, total separation, including quits. Layoffs. Now, we've been looking at layoffs for a while because they sound a little scary, but unless you're paying attention to it, you really don't know what the normal rate of layoffs are because you're just simply not watching. Discharges, fires, and other separations. Quits are generally voluntary separation. We know what they are. Therefore, quits rates can serve as a measure of workers' willingness and ability to leave jobs. The biggest point with a quit is, I'm sure you've thought of this already, if you feel like the economy and your life and everything is going really well, then you might have a good opportunity to go somewhere, you might jump ship. You might be like that frog and hop from lily pad to lily pad. But as you get less confident that that next lily pad is going to float, you're more likely to stay where you are. And so that's why quits has a psychological kind of interpretation thing. If you see the quit rate suddenly go down, we can kind of impart a little bit of an idea to that maybe people aren't really all that confident in what's going on. If we go back to it, in July, the number of quits was essentially unchanged at 3.3 million. So the whole thing we've got going on here is a lot of not much changing going on as we see. It's just everything kind of business as usual. Again, this is from the BLS. You can find the link to the BLS there in the description of the YouTube page where this lives. Layoffs jump in August. That's part of the equation. While hiring, that's the other side of the coin, in 2024 is at a historic low. A Challenger report shows, and this is a group of people. This was done today, I think it was. Jeff Cox, yes, September 5, yesterday. We're going to look at that. Layoffs soared in August, hitting their highest total in the month's Layoffs soared in August, hitting their highest total for the month in 15 years. That's an August month, August to each consecutive year. While year-to-date hiring hit the lowest in the 19 years of Challenger Gray and Christmas survey. The report shows the biggest growth in planned layoffs came in the technology field, with companies announcing 41,829 cuts, the most in 20 months. Well, we've known we kind of see this tech bubble thing maybe coming at us hard. Now, we've already looked at it at the important part. It's that hirings are down and layoffs are up. So that's not sounding too confident for the economy. But what is the magnitude of that? We'll know when Jay Powell speaks. Announced job cuts totaled 75,891 for the month, lurching 193% higher than July. Well, that doesn't sound good. Clickbaity. Let's move on. Jobs reports. August payrolls grew. Same CNBC, same guy, Jeff Cox. August payrolls grew by less than an expected 142,000, but unemployment rate ticked down to 4.2%. Remember, we were looking at 4.3 and people were having a cow. Let's cut the rates because unemployment is going up to 4.3, I think it was. Well, it just came down to 4.2. A lot of this is just noise and nothing much to get excited by. Yes, we're trickling up, but it doesn't mean that the world is coming to its end. So what does it mean if we get our rate cut? We get our rate cut of 25 basis points. It's not really making that big of a deal on your monthly payment, to be quite honest, in most cases. We're going to end the segment. We're watching the local markets and reminding you of something very important. And of course, for your informational purposes, we do remember that we have CallDelToSell.com website. You see behind me the link to remind you, but if we come across here, let's just see what Rutherford County is doing and can check it with Murfreesboro. So we do the entire county. We're looking at pricing trends. We see we've gone up, had a little dip already going down in 2023. So we can dip a little bit and it not be abnormal. We are seeing a little bit of the pricing trends come down now as of August. Let's see how. Let's look at one more thing. Let's look at showing, see what they're doing. That gives us an idea of the activity. So across Rutherford County, we are going up. We're an abnormally high, actually, because normally we peak out somewhere around May or June. All right, so that's July. It's peaked. What is this one up here? May. All right, we're still going up for the 24 season. So we're looking pretty good there, I think. Let's check on Murfreesboro specifically. Single family Murfreesboro, we are seeing a little bit of a price volatility, but it's not crashed by any stretch of the imagination. And let's pull that showings up, see what's going on. It's beginning to taper a little bit. We peaked in June, and we see that that's not uncommon at all for that. So we're still progressing right up the ladder as far as prices go, and we're still showing homes, and things are still going along. The 25 basis points I don't think is going to make people lose their mind and everybody want to jump in all at once. And I don't think it's going to scare anybody out of the market who's truly looking so far. So we're pretty well much right on the march as far as Chairman Powell has predicted. Q3 of 24, I expect 25 basis points, no more and no less. Either way, I think could send some shockwaves through the markets. So let's get over here to this main pane. The main window pane, CNBC, again, we're looking under markets. We're looking at how they closed today. And it looks like the more locked in assuredness, I think we're 99% sure we'll get a 25 basis points cut. We may even get more toward 50, but it's a lesser amount. We look at all the screens are red. They're not terrible red, are they? 1%, whatever. It's not like we had with a carry trade. NASDAQ, I thought, was up earlier today. The only one that went down, and look how it swung. It's got the biggest drop of the bunch, 2.55%. Stock exchange, utility, NASDAQ, they're down, down, down. What about these individual commodities? Down, down, down. Well, there's one up. Natural gas is up. Of course, we do have winter coming, so that kind of explains natural gas, I think. Treasuries, now this is an important part. We want to look at the 2-year, which is right here. It's at 3.654. We want to look then at the 10-year, 2 and 10. And we see that the 10-year is now higher than the 2-year. So our curve closed uninverted. All right, we've been here a dozen times before. The Fed Reserve Bank St. Louis, the FRED economic data is what the ED stands for. And when we look at this, what do we see? We see above the line, below the line, and we see this little bit right now. We have just crossed over the line, and it looks like they booked us. Looks like right about here we probably teetered across the line but closed back inverted. Well, let's just stretch this out to say the max. This is what I want to point out. Doesn't mean anything bad has happened. If you've watched the show before, I've showed you this. We look, when we go inverted as we're going here, back in the day in 1980, you see we hit a recession while it was actually in an inverted state. We hit a recession when we're in an inverted state. Here, though, in most modern histories, we don't hit the recession till after we've uninverted for a period of time. There's a lag here. Look at that's 1990. Look at the 2000s, right? We still pop up. We have about April, and when did it start? Down here somewhere around December. So we have about 4 months, maybe a quarter. If a recession comes, is it true back here? Something around here. We're looking at August. And when did it uninvert? Looked like it almost uninverted there. So March, so that's going to be in that 3 or 4 month range. Look, what about here when we uninvert back around 2008? We didn't hit the recession officially until I think about 6 months. December, yes, December from May to December. So that's very close, 6 months, 7 months actually. Now we didn't invert during this one, but we've definitely looking at the length of time that we stay inverted indicates how quickly perhaps a recession will come if it comes. When it's only inverted a little bit, we have a little bit longer period of time, as we see right here in 2005 to the 2007 when the recession hit. Go back to 2000. It's a little shorter. We weren't inverted for a long period of time. This might not be a great sign, but if we've been under for how many months since 2022 and now we just now uninverted in 2024, well, that would seem to suggest that we have perhaps a longer period of time until we were to hit a recession, and perhaps the recession would then be a little bit longer because we spent so much more time where the short term was paying more than the long term on the bonds, the treasury bonds. So we have a mixed bag of signals that you can see about anything you want to. It's like looking and finding an elephant in the clouds. I don't think it looks too bad for the immediate future. I do expect 25 points, mostly because we've spent since December of last year saying Q3, and I think if he doesn't cut, people will fear inflation and the markets will have a bad day. And if they cut more than that, go 50%, I think the markets will have a bad day because I think they'll take it as a recession trigger. Recession is here. But you see within the jobs, even within the jobs, they're not all bad. And in their magnitude, they're not significant. We're nowhere near 5% unemployment. So I don't think there's any reason for the baby out with the bathwater. Hello, I'm Delbridge of Benchmark Realty, Murfreesboro, Tennessee. If you are currently unrepresented and would like to know how to compare up to 3 properties side by side and room by room, then go over to my new YouTube channel, CallDelToSell. That's 1 L and Del, no spaces. Watch the demo on Real Scout and then call me and we'll set up your exclusive ad-free account today. Now our numbers last week, 8/30/2024, we had 23,323 in the opportunities. That went up. Over the previous week, we were 4146 in the under contract still showing. That was down a little bit, but not really significantly. And we kept the ratio at 18% as we had for the 2 previous weeks. This week, 9/6/24, we have 23,090 in the opportunity. That's down less than 300 over the week. We have 4074 in the under contract still showing. That's also down, but that's about 75, give or take, a little less than 75, just doing the math in my head. And we kept the ratio at 18%. So we're fairly steady as we are.